Hi, everyone. I'm Rick Bensignor, and this is In the Know Trader for StockCharts.com. This week, we're going to talk about some of my upcoming public appearances. We'll go through the macro sector relative movement chart like we do every week. We'll certainly take a look at the S&P, and we'll spend some time on it given what's gone on the last few days. And then we'll go and revisit some of the biggest cap tech names out there, what I've called MAFANG. So we add Microsoft and Apple to the standard Facebook, Amazon, Netflix, and Google of traditional FANG names, because I think it's really these six names that have the most influence not only on the indexes themselves, but also just on the psychology of the market. So that's what we'll do for this week. So let's start off with upcoming public appearances. This coming Tuesday, a week from today, I will be guest hosting on Bloomberg TV from 8 a.m. to 8:40 a.m. Eastern Time. So you'll get a good chance to watch me and hear my thoughts about a variety of things over that 40-minute segment. Then in February, I know that I will be speaking at the Money Show in Orlando. That is the first, let me think, actually it's the second Saturday of February, so it's February 8th. And those of you who are in the Florida area, I will be talking about some of the key elements in lining up successful trades, and it'll give us a chance to also meet in person. So catch me there if you can. Again, you can sign up at the Money Show. And that is, by the way, for those of you who don't know, Money Shows and Traders Expos are run by the same parent company, and they are done throughout the country. Virtually every month, they have a conference somewhere in the country. These tend to attract very decent-sized crowds, get a lot of good speakers in them, and you can sign up for those for free. They do have some paid portions of the 2 or 3 day seminars if you want, but you can also attend fully without paying a thing. And that's the good thing, that Kim Gittler, who put this together many years ago, wanted to be able to educate the public as much as she possibly could about the markets. And that's why she has some very good speakers come to each one of these. And again, you can go to many sessions without paying a penny to go. So check those out. We will talk about, again, the macro sectors, so we're going to move on to that now. And here's, again, on the right-hand side is through yesterday's close, year-to-date relative movement of the S&P 11 sectors, the 11 macro sectors to the S&P itself. Anything north of the zero line has outperformed the S&P year-to-date. Anything beneath the zero line has underperformed. And we compare it to how the same picture looked a week ago to see what has changed. And we highlight in either red dots or green dots those sectors that have moved 1% or more. If they have red dots, then they have fallen 1% or more in relative performance since the prior week. And if it has a green dot, then it has outperformed by 100 basis points or more since the prior week. So only 3 sectors in the last week have changed by that criteria of 1% or more that I artificially picked, but I think that that's not a bad way of looking at things and highlighting what's going on in the market. So the first red dot that we see are industrials. They had been up 4.69% last week year to date. They're only up 3% now, so the industrials have gotten hit recently. Energy, which has always been the bad boy for the entire year, lost a full percent in the last week, and pushing it down to now minus 18.82% relative to the S&P. So it's underperformed by 18%. Of course, with the S&P being up over 20% this year, that still puts energy in the positive category year to date. It's just, you could have been anywhere but there and done much better. And then consumer staples, which had recently come from decently outperforming to underperforming by 1.84% last week, is now up about 50 basis points or so versus the S&P. So basically flat on the year, doing what the S&P is doing, but it has picked up some performance in the last week. One of the notable things that we see, it didn't change week over week, but still, healthcare has still been a problem for a lot of the year. The second worst performer for almost the entire year. Occasionally, it's slid in front of energy as being the worst performer, but it has come back nicely over the last few months. So it definitely has gotten a bid, and although it's trailing by 8%, it is well better than it used to be. And the other one, of course, that's made significant movement over the last few months is the real estate sector on the far right-hand side. This had been the second best performer for the whole year, trailing and sometimes fairly equal to what technology had been. Obviously, technology is the best performing sector this year, but REITs have come off hard over the last few months, and they're virtually flat to what the S&P is doing. So, besides tech as a major outperformer, and besides energy and healthcare as major underperformers, everything else is kind of within the realm of normal market rotation. But, if you were not in tech this year, you could not possibly do as well as you should have been able to do, and or match the overall performance. And if you were overweight energy instead of being underweight energy, you got hurt badly too. The key was realizing just how bad energy was fairly early in the year and sticking with that throughout the year. Back in September, I think it was the first time that we were willing to go and kind of push against and start looking at energy as a cheap sector. I'm not sure offhand what it's done since early September when we started looking at it, but if it's underperformed, it's not by much. So I think energy is starting to create some type of potential bottom in relative terms to the S&P. So I do look for names there, cheap names fundamentally, names that have been beaten down on the charts where I actually can find some long-term support. And, some of those I'll take a look at and potentially buy. But that's the sector review. As far as getting in touch with me, Rick at inthenotrader.com is the best way to email me. Our website, inthenotrader.com, is your resource for lots of videos about how to make money in the markets, prior interviews I've done, Real Vision interviews, and information on how to sign up and subscribe to our weekly newsletter. So what we do here in this podcast each week just touches upon what our weekly newsletter goes over. Again, our goal has always been to give you access to models that you would not be able to get anywhere else, and to align yourself more with how institutions trade and where they put their positions on. Instead of simply looking at basic technicals, we incorporate a fair amount of market timing into the procedure, as well as, again, using institutionally based models that give you a far greater edge than simply playing without them. Let's move towards our charts now, and we'll start off with the S&P, and you can see a lot's going on over the last couple of days. So let me fill you in kind of about what I'm seeing and things happening right now. So first off, again, I'll refer back to, let me just find my cursor if I can. There we go. So here on the left-hand side in July, we had a sequential 13 count. That is looking for exhaustion of trend by the fact that the number showed up on top of the price bar, says it was looking for exhaustion of the uptrend, and that certainly was a good call going into the August decline. We had another one recently, and these bold red dots at 3141.81, so virtually 3142. Let's blow this up a bit, is the stop out level for the exhaustion signal. So if, let me just move this a touch. So if we see this 13 signal here that showed up on November 19th, it said if we properly hurdle 3142, disregard the 13. Well, we got above 3142, but not properly, which is why these red dots are still printing on my screen. This is all done through the computer software I use that says this is still an active signal. So we had a fairly large down day yesterday. And then today, we're actually right near the highs right now. So we've kind of bounced. Look how much we've bounced off the lows. The S&P is now only down. I mean, it's still down almost 1%, down 28 points, but it was down 15 more points than where we're trading now. So it has bounced, but certainly a big gap down in price. So let's kind of talk about what this means and how we look at things. We know that we had targets between 31.22 and 31.36, and then when the 13 printed, it extended the target to the upside target to 31.42 as being potential resistance. So we had a line here, which was an equal legs move up from the June low. So if I show you, and we go to the early June low, which was the major low, and we measure the rally. We take that same distance off of the low we saw in August. That says what I call an equal legs move up, equal distant move, got you to 31.22. Unrelated to that is from this, we measured trend factors, which is again kind of it's a DeMark institutional model that said that look for resistance at 31.36. So now I have 31.22 to 31.36 as a zone, and then we get, unrelated to that, this new sequential signal that says potential for upside exhaustion, all kind of coming into the same range. So this is an active signal suggesting that anything north of 31.20 is not a time you want to be buying in this uptrend. At a minimum, that's what it's saying. At a maximum, if you take it all the way to the other side of the equation of what it could possibly mean, it says that if you're aggressive, this is a place you could consider selling and or shorting, depending upon how aggressive you want to get. Now, if you had shorted the market back here in July when we got that signal, also up against a propulsion target at the time of 30.35, so we had kind of couple of targets show up again right as the high was being made, that ended up being a very good trade. And you could have taken in almost 200 S&P points if you were good enough to cover down near the lows. A similar signal is showing up now. And I can't tell you we're going to fall 200 points and look at a similar type move, because as of right now, there's a couple things showing up that it still give me some belief that the game to the upside is not necessarily over. First off, from the large gap up that we saw in early October between the 10th and the 11th, if I draw a trend line that's been in place since then, today we were trading beneath it, but at current pace, we're above it. And as long as, here, let's see what that value is today. That trend line's value is 30.80. So closing above 30.80 keeps that trend line intact. So you still, all you've done is pulled back to a trend line, and you could still possibly head higher through the balance of the year. Secondly, we broke beneath this purple dotted, or deep, we'll call it deep purple at 30.98, the propulsion bearish level, and we gapped beneath it. But yesterday was a down close, which means today's move underneath it was not qualified. So you're going to have less professionals selling this because yesterday was already a down close. And a down close will disqualify a move beneath a particular level of significance. So for the short term, I'd still be in the camp of I'm just simply not going to buy right now and wait to see what happens over the next several days. If we close underneath here and gap lower tomorrow, my guess is we go down to 30.42. Now, that's only a little over 1% away, so for long-term investors, it's not important. For short-term traders, it may be. So I'm going to look to see what happens if we get up to 30.98. If we reject it, if we do, and we come back down, then I'm going to assume that we're going to go down here to 30.40. If that breaks in any significant way, then you potentially have a much bigger decline coming down to 29.28, which I would not anticipate to occur between now and year's end unless Trump keeps this the hawkish tone up about doing the trade deal. Obviously, the last couple days, the negative comments coming from Trump about getting this deal done, not only before the December 15th increased tariff headline, but even getting it done before the end of the year is what's pushing the market lower. And one of the things that we've said for quite some time to our readers is that Trump as president has kind of changed the game as far as how communications are done from the office of the president to the public. You know, we haven't had a president before who tweets so regularly, if at all, in official capacity. And it's much harder dealing as an investor with somebody who, you know, at 2 a.m. can tweet something out that changes everything about the market. I think in general, investors were fairly confident just based upon prior information given to us from the government that we were well on the way towards getting phase one of the China deal signed. Now it seems to be much more in question, and we don't know how much of this is tactic by Trump to force the Chinese. I was listening this morning to Wilbur Ross, Trade Secretary, and you know, he said we have much more leverage than the Chinese do in negotiating, and therefore he feels as if the president's doing the right thing in holding off and making sure he gets the right deal done. I can tell you from an investor's point of view, the news headlines now are going to be taken seriously to the point that you see what happens in 2 days, how quickly the S&P, you know, can drop several percent. If bullish news comes out, it'll get it back as quickly as it fell. But the market is going to be very sensitive to information that would suggest that the trade deal is not going to get done in a timely fashion, and that tariffs will be re-implemented on December 15th. So, you know, today's December 3rd. There's 12 days left to figure this out. The Chinese know it. Trump knows it. So it's going to be interesting to see how this plays out. If we continue to see downside pressure, again, I'm going to look for 3042 as first level support. At this point, the bottom of the cloud starts moving higher as we get farther and farther into December. So that's going to be important, as well as the lagging line against the bottom of its cloud, which is 29.25, which it's surprisingly just about the same level of 29.29, where the propulsion exhaustion level is. And it's where the trend line is from June's bottom. So that, you know, roughly the 29.25 level, if it came into play, would be hugely important. And at that point, that would be a couple hundred points down off the high, and it would be a similar type 200-point decline like we had seen off of this 13. So to me, let's move this to a weekly chart. When we look at the weekly S&P, the key level I'm going to look at is 30.06. That's the propulsion level on a weekly chart. If we get beneath 30.06 on a Friday close, then I start getting much more worried, especially, and I do not anticipate this happening, but if that were to happen by this Friday's close, then I'd even be more worried, because last week was an up week for the market, which means this week, if we were to close underneath 30.06, then I have a much bigger problem potentially at hand. So that to me is the key level, and it's kind of my line in the sand. It's where I get more concerned about the bigger picture of what's going on in the market. So that's my look at the S&P. And, you know, look, for you, if you're a short-term trader, there's reasons to think that you could start to look to sell into a subsequent rally. So if we go back to a daily chart, maybe even cut it down to, let's say, a 60-minute chart, you look at the S&P and you start trying to figure out, we had the big gap down. Where is resistance? So the last high before it broke down was 31.25, kind of right in here. If we were to get back up into that area, you're also going to have some 60-minute cloud resistance. So perhaps that's where I'd look to lay out stock, S&Ps, if I was looking to trade. As far as investors are concerned, a couple of percent off of all-time highs is not an important enough down move to say that you want to make material shifts to your portfolio. So always remember, a lot of this comes down to your time frame, your risk tolerance, but more importantly, am I a trader or am I an investor? And if I'm an investor, I'm not going to let a 2% or a 3% decline off of all-time highs that were just made a few days ago give me a big problem. Also, recall that I've said this in the past, this is the third year of Trump's 4-year term, and traditionally, if you look back historically, the third year is the year that's the strongest and tends to go out on the high of the year. Now, there's nothing that says it has to, but it traditionally, if you look at the charting of cycle charting as per the term, year 1, year 2, year 3, year 4, this is the year that typically goes out on the high. So this could all be, rhetoric and political jawboning, and we'll see. The next key thing is what happens between now and the 15th, and whether or not on the 15th the tariffs get put back in place. If they do, I don't think the market will like it very much, and that could easily stop the market from closing near its highs on the years. Notice also, just in a simple sense, the daily MACD has gone into a sell signal, and more so than we saw just on the crossover back here mid-November. Now you have more of a spreading out of the two lines that make up the MACD signal, so that does give a little more downside, the initiation of downside momentum. Okay, let's take a look at some charts now of just the FANG names again. Here is Microsoft on a daily chart. Here we go. So this got a 13 upside exhaustion signal, the first one in many months. Last time we had one was April. The signal came in just before it probably gapped up on earnings, and then it did fade right away into a 9 down. Rally, touched the cloud, and then kept going. So we know the cloud is important support here. Look back in May, early June, cloud support. August, when the S&P sold off, cloud support. Even in October, even though you had one close underneath the cloud here and one close here, the lagging line was still above its cloud, never went into a sell signal. Here, the problem becomes is if you start getting daily closes underneath 136.5. That's kind of the key support level for Microsoft at this point. On the upside, if we can get back above 153.11 and stop out the 13 signal, then upside targets between 157.5 and 168 and change. Apple, stronger chart actually, and you can see multiple 13s here on the left-hand side. Same type thing, very similar to Microsoft. 13 went a little higher and then fell into a 9 count. This is also at cloud support. It's well above its cloud now, 13 and 9 in the middle of November. Stock has not been able to progress above the stop out line. Again, that one close was not done because the day after that close opened lower. You didn't get stopped out. This is still an active sell. Today, it bounced off its propulsion level, which makes sense because yesterday was a down close. So is more of a place for buyers to show up as compared to sellers. There should be some resistance just based upon 2 weeks worth of overhead supply. It's not a ton, but this would suggest to me that you'd probably be a seller if you're looking at, either short Apple or take some profits in it. A bounce to 260, 262 or so would be the place to do it, and then stop yourself out above 266.66. Facebook. Very different looking chart. Look how the 13s can be really helpful. This one was a little early. This one kind of comes in a day or two before the, I think that's probably all-time highs, or certainly, let's see. No, it's not the all-time high, but it's certainly the cyclical high into a 13 bottom, and now into a 9 up that has stalled. So similar to Apple, this bounced right on its propulsion. So this was disqualified today because yes, it was down close. That made this level of 194.44 a buy. And so we get very close to that. Let's see. Today's low is 195.08 in the propulsion level, 194.91. So we got 15 cents or so away. Got a good bounce. There's not much overhead supply. There is some, in theory, back from the highs in July and highs here. Let's see. If I didn't have a position on at Facebook and I was totally flat, I'd probably look for, if I had the opportunity sometime in the rest of December to get long in between 185 and 190-ish, I would take my chance there. Otherwise, this has been fairly sideways for months, and I don't want to play much in the midsections. I'd rather play more on the extremes, so I probably would take a look at maybe an RSI or a MACD for overbought, oversold. Right now, you got an RSI of 52, so nothing to do right here. Again, when you're in a somewhat sideways pattern, you're going to want to use oscillators more than anything else. Amazon. So this name is the weakest one we've looked at so far. 13 potential downside exhaustion. We got another signal here, so I'm more looking to be a buyer of Amazon than anything else, just based upon that. Anywhere from those lows all the way down. So this is going to have some risk to it, simply because of where the stop outs are associated. Generally, I want to buy this on weakness if as long as the government doesn't rip this company apart, which has a better chance of happening if, let's say, a progressive Democrat gets in the White House, then I'm generally looking for places to buy Amazon on pullbacks. If it got back, if it took out these lows and even got to 1650 area, that would be a potential place. Let me look at it on a weekly chart. So weekly has important support down to about 1600 or so for all the way through the first quarter of next year. One thing here, this can get, on a rally, this can get a 13 sell signal, but the risk is going to be big. So I'm just a general buyer on weakness here. What do we have? Netflix. Netflix on the weekly chart has 9 pretty close to a bottom here, 9 pretty, so these are setup 9s. Look for resistance, 320. This is more of a trading stock. There's a fair amount of overhead resistance here. You get back near 340, 360, you're probably a net seller, and anything down near 260-ish to 240-ish net buyer, looking for a big range. And the last one, Google. Google made all-time highs a few weeks ago. This is actually one of the better charts, hasn't sold down as bad as some of the other ones. So upside targets are at 1346. On the downside, if the opportunity came to get long at around 1177 or so sometime in the next several months, that's probably the place. Otherwise, right in here, it is a hold. And there goes our half.